A corporation, or a company, is another form of business ownership that is different from a sole proprietorship or a partnership. Company form of structure is very common and preferred by all large businesses all over the world. When you form a corporation, you create a legal entity. This process is more complex than starting a sole proprietorship or a partnership. About 20% of businesses in the United States use company form of business structure, but they account for about 90% of the total business revenue in the United States. Let us explore what we mean by company or corporation form of business structure, and what are some distinct features of this structure. Definition of company. What we mean by a company or a corporation. You have probably heard the word corporation. A number of large corporations exist nationally and globally. Some well-known examples are IBM, General Electric, Sony, Microsoft, etc. A corporation is a business organization that operates as a legal entity that is separate from its owners and is treated by law as if it were an individual person. A corporation is an artificial being, invisible, intangible, and existing only in contemplation of law. Being the mere creature of law, it possesses only those properties which the charter of its creation confers upon it, either expressly or incidental to its very existence. Being an artificial entity can do everything that a sole proprietorship or a partnership can do. It can own property, buy and sell merchandise, pay bills, and make contracts. It can also sue and be sued in the court in its own name. A company actually is an association of persons. Persons who have contributed money to carry on some business or undertaking. They are issued a common stock, and company employ the money for the defined common business purpose. Persons who contribute the money are called the shareholders or the members of the company. The common stock so contributed is denoted in money and is the capital of the company. The persons who contribute it, or to whom it belongs, are members. The proportion of capital to which each member is entitled is his share. The affairs of the company are managed by a separate body, often called board of directors. This way, there exists segregation of ownership and management. When a sole proprietor retires, dies, or sells his or her business to someone else, that business ceases to exist. Similarly, in case of partnership, when each time the partners enter or leave a partnership, a new partnership must be created. As we have explained earlier, that one of the distinct feature of company structure is that the shareholders own the company, but a separate management runs the business. In a corporation, due to this segregation, a change of owners does not end the legal operation. Shareholders or members may enter or leave at any time without affecting the existence of the corporation. Its legal status as a business can continue indefinitely. Hence, the company enjoys perpetual existence, which was a big limitation of earlier discussed business structures. Now let us summarize what we learned so far. 1. A corporation is an artificial being, invisible, intangible, and existing only in contemplation of law. 2. Corporations issue stock. Persons who contribute the money are called the shareholders or the members of the company. The affairs of the company are managed by a separate body, often called board of directors. 3. The corporations operate as legal entities, separate from owners and continue, no matter who owns them. A separate legal entity is a person recognized by law. The legal entity has its own legal rights and obligations, separate to those running or owning the entity. A corporation is a business organization that operates as a legal entity that is separate from its owners and is treated by law as if it were an individual person. Once incorporated, a company assumes the identity of an artificial person. An incorporated company is a corporate body, and by action of law it is treated as a legal person. The company may sue or be sued by its members or shareholders. The company can enter into contracts in its own name, and likewise may sue and be sued in its own name. The company is a separate legal entity, distinct from its management and shareholders. Company affairs are managed by a board of directors. A company has perpetual existence and is not affected by the joining, leaving, death, insolvency or insanity of any of its shareholders. Because a corporation is a separate legal entity, it must pay state and federal income taxes on its profits. Dividends that stockholders receive are then taxed again in the hands of shareholders. A corporation is the most preferred form of business structure because, apart from being a separate legal entity, it also provides protection to its owners, directors, and officers from personal liabilities. You have learned, on our earlier videos on business structures, that sole proprietorships and partnerships are fairly easy to set up. In contrast, a great deal of work is required to incorporate a corporation and formally commence your business. A person must complete many forms, file reports, and adhere to many local and federal laws and regulations. As a result, for incorporating a company, a great amount of work and organization is required. Forming a corporation also costs a large amount of money. Some costs of creating a corporation include legal fees, licensing costs, filing fees, costs of issuing stock certificates, and administrative costs. Post that, there are compliance and regulatory documentation and filing requirements that need to be adhered on a constant basis. To create a corporation, you must file an application with the state for permission to operate. The name of the business you want to use must also be approved by the registrar to avoid any conflicts and similarities with other businesses. The application to operate as a corporation is called the Articles of Incorporation. The application includes information such as the corporate name and the type of business in which the corporation will be involved. In addition to the Articles of Incorporation, you must write a set of corporate bylaws. Corporate bylaws are the rules by which a corporation will operate. Items in the bylaws may include how the company will elect directors of the corporation and when stockholders will meet. When the state approves the application, it issues a corporate charter. A corporate charter is a license to operate a corporation. It states the purpose of the business and spells out the laws and guidelines under which the business will operate. To create a corporation, you must file an application with the state for permission to operate. The name of the business you want to use must also be approved by the registrar to avoid any conflicts and similarities with other businesses. Companies also have to adhere to Registered Office Clause. It need to specify at the onset itself in which state the company will be located. Company also need to specify its Object Clause. From the Object Clause, one can get information about the business activity of the company. It shows the purpose of the company. Please note that a company cannot conduct any business activity which is not mentioned in the Object Clause of the company. After registration, if a company wants to start a new business stream, then it needs to alter or change the Object Clause. We know that company is an artificial person. To regulate the constitution and affairs of this juristic person, constitutional documents, also called charter documents, need to be created and registered. The documents basically define the existence of the entity and regulate the structure and control of that entity and its members. There is a need to define and regulate the company's activities that it will or it can do with the outside world. A memorandum document defines such conditions and rules, such as the company's objects and powers. Memorandum of Association helps the shareholders, creditors, and any other person dealing with the company to know the basic rights and powers of the company. In addition to this, you must also write a set of corporate bylaws. The rules by which a corporation will operate. How you will manage the internal affairs of the company. Items in the bylaws may include how the company will elect directors of the corporation and when stockholders will meet. When the state approves the application, it issues a corporate charter. A corporate charter, also called Certificate of Incorporation, is a license to operate a corporation. Next step is to complete various formalities and obtain business-related clearances from various authorities. State registrations like establishment registration and license. Federal registrations like customs or import-export registrations. Tax registrations for both state and federal. Licenses specifically applicable to the business, like banking or hospital, etc. Company law formalities, filing any information required under the applicable corporation-related act. Compliance with all employee-related laws. Once all registrations are in place, the company is ready to commence its business officially. The ownership of a corporation is divided into units, which are called shares of stock. Corporations issue shares of stock to raise money for their business. These shares of stock are bought by people who invest money, and they become stockholders. Stockholders are the legal owners of the corporation. The shares that are issued represent the amount of money invested by the shareholders in the company. Even if you buy one share of a company, you are legally an owner of the company and have all the rights of ownership. Each stockholder receives a stock certificate. Stock certificate is a document issued by the company and is the proof of the ownership. Small corporations usually have only a few stockholders. Larger corporations, such as IBM or General Electric, have thousands of stockholders. Many small and family businesses are organized as closely held corporations, in which case shares are owned by a relatively small group of people and not traded in stock market. On the other hand, publicly held corporations sells its shares openly in stock markets. Due to this, anyone can buy them, and shares are also traded on a stock exchange. Almost all major corporations are generally publicly held. What are the benefits of forming a corporation? Establishing your business as a corporation has a number of advantages over a sole proprietorship and a partnership. They are ability to raise capital from a large number of people, separation of ownership and management, limited liability of the shareholders, and continued life of the company. Due to these advantages, corporation is the preferred structure when increased capital, limited liability, scalability, and sustainability are key considerations. Let us now understand each one of them in a little detail. A major advantage of a corporation is the ability to sell its stock to a small or large number of investors. This way, it can generate the required amount of capital or money. If the corporation needs additional money, say for growth or expansion, the company can even sell additional shares. Issuing stock involves selling pieces of ownership in your business to investors in exchange for cash. Issuing stock leaves you with more cash available compared to debt financing. The owners do not run the business in most publicly held corporations. Instead, they elect a board of directors, a group of individuals who are responsible for overseeing the general affairs of the corporation. Professional managers are hired to make day-to-day decisions in running the business. However, in smaller, closely held corporations, the owners may often act as the managers also. The separation of ownership and management usually does not occur until a company grows large and goes public. A great advantage to the stockholders or owners of a corporation is that they have limited liability. Limited liability is a legal status in which a person's financial liability is limited to a fixed sum. This fixed sum, most commonly, is the value of a person's investment in the corporation. If the company is sued, then the claimants are generally entitled to collect only against the assets of the company. The assets of its shareholders or other investors cannot be claimed. Shareholder is not personally liable for any of the debts of the company other than for the amount already invested. Hence, limited liability concept promotes investment and capital formation by reassuring the risk-averse investors. Perpetual existence is a very important characteristic of a business corporation. It means corporation has no expiration date, it is practically unending, and has unlimited term of existence. But perpetual existence, in this context, is a relative term. The corporation may go out of business, be acquired by another entity, or otherwise cease to exist, due to decision of members or state. The term actually states that a corporation exists as its own entity, regardless of what happens to the individuals involved in the business. Due to this concept of perpetual existence, the corporation continues, even when there are changes in the shareholders, directors, and officers. This gives confidence to investors, put their money, and raises the chances that the investors will see a return on their money. What are some of the drawbacks of corporate ownership? Though the corporate form of ownership has a number of advantages, it also has several disadvantages. The first being complex and expensive setup. We have already explained that a great deal of work is required to create a corporation. One must adhere to many formalities and abide to many laws and regulations. As a result, great amount of effort and costs are involved to set up a company business structure. Secondly, a major disadvantage of the corporation is the slowness of the decision-making process. In corporations, as management is different from owners, many different people are involved in making a decision. The process can take even more time if disagreements occur. Thirdly, as a corporation is a separate legal entity, it must pay state and federal income taxes on its profits. Dividends to shareholders may also be taxed again in some jurisdictions. Lastly, corporations are subject to many compliance requirements and regulations. This is done to safeguard investors and other stakeholders. These compliances may be too overwhelming for a small business and often require professional help. Now you have built a basic understanding of commonly used business structures. One must carefully consider the advantages and disadvantages of each business structure, and then only decide which one may be the best for a particular business scenario. We hope you enjoyed this video as much as we enjoyed making. Complete course along with certification is available at www.technofunk.org. Please like this video, provide your feedback using our contact form and help us with your comments. If you like this, please share with your friends. Subscribe to our channel to get notified of new tutorials. And don't forget to press the bell. Thank you again for watching our video.